Good afternoon, everyone. Looks like people are joining us, and we're going to go ahead and get started. Welcome to today's webinar, What a Difference a Year Makes, Markets in Review. This is Catherine Barr, Director of Communications at New Capital. Thanks for joining us today. And before we get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there's also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you. And now here's Leonard Golub, financial advisor and founder of New Capital Management.
Hello, everybody. I hope you're doing well. Welcome to today's conference. It's been a while since we've done one of these. And it's been a while since I've written anything. We've just been very, very busy, and I had the sense that after a really tumultuous 2020, people were enjoying a little bit of quiet. Period, maybe since the presidential inauguration till today. It's been a really lovely spring, of course, after we had that really tough winter storm. I'm here out at my ranch and still having some plumbing issues. Haven't gotten, there are two houses here and one of them haven't restored the water yet. So I hope everybody is doing well and recovered from that and enjoying the spring. I had a wonderful weekend. I went on a 3-day bike ride with some friends around not the hill country, but this area around Cat Spring and Belleville and Brenham, and I concluded this area really needs a name, right? Like, you know, like Tuscany has a name and the hill country has a name, and it's a beautiful, beautiful area. Really amazing bike riding. So I feel good, I feel refreshed, and needless to say, I was, you know, half a mile behind everybody the whole way. So that's how it goes. So we'll go through a few things. We have completed our performance survey. Thanks to everybody who took the time to fill it out. We give, I think, a $20 donation to the charity of your choice. We give you a list of 10 or so, but it really helps us know what we're doing well and if there are areas that we can improve on. And almost always there are some things that we can do better. Although this was another year where we got really good high marks. So thank you for participating in that if you did. Quarterly reports are out. They've been out for, I don't know, about a week now or so. You can take a look. My guess is that the vast majority of you will be pleased, even very pleased at the performance reports, and I'll be talking about why in this presentation and what's going on with performance in portfolios. But if you have to go right now and you were just tuning into the first bit of this meeting, the synopsis is basically that our portfolios have been performing very strongly and outperforming benchmarks since about October of last year, and that's continued into 2021, and I'll talk about why that is. 360 is our internal product that we've been developing. Some of you, maybe even some of you on the call today, are helping us as beta testers, and thank you for that. We really appreciate that, and I expect that later on this year we'll be releasing this client information system to to all clients. This is a system that will contain all your documents and just about everything. Our goal is it's something that you'll be able to log into and get just about every bit of financial information that you could want on your household. So thanks to those of you who are helping us do testing. I have a pretty big announcement to make here. Orion is a portfolio reporting and rebalancing system. And we have made the decision about a month ago to leave Morningstar and to move over to Orion. We've signed a 3-year contract with Orion. And so we are in the process of porting our systems over from Morningstar to Orion. It's been a long time coming. Morningstar's done a good job for us, but they have not managed to really innovate their software the way that their competition has. And it's started to cause us a few problems a couple of years ago, not in the presentation of the reports or the reports themselves, which were fine, but in just how the software works. For example, their product still only runs on a desktop computer. It doesn't run on a web-based version, and they wrote a web-based version, but it was a complete failure. And so what that means is that if we ever want to get to our clients' data and we're not sitting right at the PC or have in our possession the notebook computer that lets us get to the system or where the system is sitting on, then we can't use the system. So, you know, we're 20 plus years into the internet, and where Morningstar failed to come out with an internet version of the software that we use for rebalancing and portfolio reporting. And they told us for a number of years that they were working on it, it was getting finished, and they finished it, and we tried it, and it was just horrendous. And none of their advisors who were still using their system are on it. So at that point, we decided that we're going to look elsewhere. There are actually several big players in this industry. Orion is one of them. We talked to them several times, and we're in the process of moving. So what that means is that your reports starting later this year, I would guess around September or into the fourth quarter, your reports are going to look different. We're going to try to make them look as much as possible like the Morningstar reports, but they're going to be different. There's just no way around that. But you will get portfolio performance and asset allocation and all that stuff. It's just going to be from a different provider. We are probably going to do a subscription to Morningstar on a smaller research product where we could still get some of the X-ray reports and snapshot reports that we've been using. And I have a call with them tomorrow to talk about that. But that's really what we want. It's just the research. There are other pieces of the software they just haven't managed to innovate. And we don't want to get stuck in something that now isn't 10 years or 20 years behind. It gets to be 30 or 40 years behind. We don't do things that way. So we'll have a lot more about the Orion conversion. If you have any questions about that today, I'll answer what I can. But as I say, we'll have a lot more to say about it, and undoubtedly we'll have a webinar on it later this year also. Okay, with that, I'm going to get right to slides. I'm going to start today with the virus. And we can see what's happened here. And let me turn this on. I don't have my pen with me. I left it at the office, so I'm gonna use this thing I found called Spotlight. That's pretty good, right? The red thing zigging around. So it's easier to see. So as we can see, we hit a peak back in January, and look, we've had a really steep fall in both fatalities and in cases. Down to what is that, about 1,000 a day. So a lot of progress here in the United States since January. Let me just ask for a show of hands. I think I can do that. How many of you, if you are fully vaccinated, raise your hand just to see what our client. So let's give everybody just a minute here. If you're fully vaccinated, I am, and Hannah is, and even Abby, my daughter, who's 16, is now vaccinated. So we've got a pretty large number of people. 66–70% of hands are raised. And then over on the right, as we can see, oh, I got to put that spotlight thing back. Okay. As we can see, this is the zone for herd immunity. And here in March of 21, we're headed there. And that would consist of people who have been either infected and or vaccinated. So if you have been infected and or vaccinated, you would be defined as being in the herd immunity pool. And you can see we're getting close to the bottom threshold for herd immunity in the United States. Around 55% of people have been either infected and or vaccinated. Only about 5% to this lower bound for herd immunity. So the country's been making good progress in that. Okay. Here is the vaccine rollout across the world. And this is percentage of the total population that has been vaccinated. All right. At least one vaccine dose. The UK leading the world in almost 50%. Look at the strides that the US has made since the beginning of this year. Really a remarkable result for a country that was experiencing the highest levels of infection during 2020. And then look at these other countries. Really, here in March of 21, much less progress on the vaccine. And I don't know why that is. Either they're not getting it, or they don't have it, or they won't take it. I don't know what the answer is, but far more progress in the US and the UK. Japan and South Korea, very low rates of vaccination, I'm assuming because they had very low rates of infection, but not so in France. Turning to other national afflictions, this is a slide showing income inequality, and we can see that for a 20-year period or so, roughly 35%, or let's see, top 10% share of pre-tax, that the income share was only 35% of the population took home the top 10% share of pre-tax national income. And we see that the top 10% of the country, that their share of the income for the top 10% has gone from 35% to 50%. So the top 10, let me state it clearly, the top 10% of income earners in the country take home 50% of the total income. And that's risen from 35%. So you see that's a very, very stark rise that began around 1970. And of course, on the right, we can see how that manifests. The bottom 90% in income spend 99% of their income after tax. After taxes, they spend 99% of it. The top 10%, who are represented here on the left, here they are again, spend 64% of their after-tax income, leaving them 33%, approximately, 1/3 of their income is available for savings, whereas only 1% of the income of the bottom 90% is available for savings. And so this is why we're seeing such a strong push now for wage increases, minimum wage increases, and jobs, because this has gone on for a long time and we've reached the breaking point. This is the employment picture, and we can see that we had a long period of employment growth from 2010. Right, this was the great financial crisis. And then we had a long period of growth when the pandemic hit. And look at that, whomp. We lost every single job that we had added since 2010. It's hard to remember, isn't it, everybody? This is why I called today's talk, what a difference a year makes. And we've since rebounded, but we're still down about 10 million jobs. We had added 22.8 million jobs between 2010 and the beginning of the pandemic in 2020. We lost between February and April of 2020, in a 2-month period, we lost 22.4 million jobs. We lost as many jobs as had been created, and we've regained 13 million. So we still have this deficit right here. And that, of course, is what the new presidential Biden administration is very focused on right now. And this is what the government was stepping in last year, especially the Federal Reserve, but in the early stages of it for the first couple of weeks, but then the Congress itself with the CARES Act and now with the most recent passage through reconciliation of additional assistance that's helped cushion this blow. These are industries, and we can see how much recovery has taken place in these industries that were highly susceptible to job loss during the pandemic. So these were total job losses. Leisure and hospitality lost 8 million jobs. Look at that. 8 million of the 22 million jobs, 1/3 of the jobs lost were in leisure and hospitality. And they've regained to date 58% of those jobs through April or through the present and end of March. And the figures I'm showing you today are through the end of March. They're not through today, so just keep that in mind, March 31st. And so they've come a long way back, but still 58% is what's been recovered, and this remains to be. Trade, transportation, and utilities, they're almost back to full strength in terms of employment. Education and health services, halfway. Professional and business services, 68% of their job losses recovered. Other services, manufacturing, 59%. Construction, 72%, has rebounded strongly. Look at government, though. Government had all these job losses, and these are probably job losses at the local and municipal level, and they've gone on to lose additional jobs since then. So the government sector really has not in any sense returned to where it was. Hardly any loss in information services, financial services, not much in the way of job loss. The mining and the logging businesses, look at that, have continued to lose jobs even through the pandemic. Okay. Budget, federal budget, look at this. So here's this proposed $1.9 trillion spending, right, for 2021. It's a $7 trillion budget. I don't know what GDP is now. Let's guess it's about close to $18, $19 trillion. So you see that the federal budget is getting almost close to 40% or so of GDP, given the new administration and the control of Congress, which is now in Democrats' hands. I think it's no secret to anybody that we're now facing, and I wrote about this back in January when Joe Biden was inaugurated, that we're now looking at the largest set of initiatives in federal spending that we've seen certainly since the 1960s, and maybe since the New Deal, which brought the country out of the Great Depression. I can tell you, having ridden on some of the roads over the weekend, it would be really nice if the federal government would hand a bunch of money over to the counties of the United States and have them expand the shoulders to include bike riders. Would be a big win-win. And then you'd have all sorts of bicycle tourism coming through this region of the state of Texas, and construction workers adding to the shoulders. You'd renew those highways. And the good news is, I think that the American people are now on board for rebuilding our country. I'm 55 and I have not seen a lot of rebuilding in this country. Yes, in urban areas, in urban centers, there's been a lot of that, but in general, there's a lot that can be rebuilt. And we're seeing the federal government now willing to spend the money to do it, although it's not an easy decision, and it's a very close political decision right now. So the elections that come up in 2022 are going to be really interesting, because we're going to get a first test as to whether the American people like having all this money used on their behalf. We're going to see if they like it, and my prediction is they're going to like it. That's my guess. We'll see. But look at the borrowing. Look how thin the tax base is. Look, income taxes appoint for $1.6 trillion. That basically pays for the Medicaid portion here. Social Security taxes and Medicare taxes, 1.3 trillion. Corporate taxes, only 164 billion after the most recent cut during the Trump administration. And of course, the Biden administration is talking about re-inflating this so that corporations pay a higher income tax. I don't know what that is, but look at all the borrowing. Roughly half of financing our federal budget is going to come from borrowing. So if taxpayers are not willing to pay for their own country, then lenders will have to pay for it. As we see it over here on the side, federal budget snapshot. Look at that. Look at the huge budget deficits that we're running during these pandemic years. I mean, towering over all else. And then the budget office predicts that we're going to see a fall back to it, but we're still not running any surpluses. Last time we ran a surplus, it was right here, looking around 2000. The line being below the axis, that's a surplus. When it's above, that's a deficit. That's how you read this graph. So, we've got a minus 15% budget deficit. And then as we can see, the net debt, the accumulated deficits that we're now running and are expected to continue to run. Look at the rise since the financial crisis. Look at the rise that has taken place to the point where the net debt basically approximates what it did back during the Second World War. That's the closest analog we have for the current level of net debt. And that's before we've really begun to even rebuild the country, right? That's really, if we think about it, the work that lies ahead to rebuild inner cities and roads and bridges and so on, we're starting with these deficits. And that's really the result of the United States having squandered so much of its treasury with misguided adventures in Vietnam and Afghanistan and in Iraq. Over all these years, that's where the money went, to those wars. So my guess is that the people of the country are ready to spend our currency on ourselves. And we're luckily beginning to see that, that there are projects that are really, really good projects. The investment that's going into energy transition now is really, really heating up, and we can see how much the rise in renewable energy has occurred over the last decade. But look, it's kind of plateaued off, and what's taking off now is storage, electrification, carbon capture, other forms of other projects in an energy transition, battery storage, for example, where to date, all the investment has been in generating power, wind, and increasingly now solar. But look what's happened to the prices. So here is the price of solar in light blue. Look at the price, look at the plunge in the price of solar power to the point where it and wind, which is green, are now lower in their cost than nuclear, which is up at the top here in orange. Here we are in today, 2020. Next is coal. Look at the cost difference between solar and wind and coal. And then natural gas, which is closer. And so what we're seeing is a phase out of coal, which has been going on, and it's ongoing. And look, global solar and wind power capacity additions. Enormous amounts of gigawatt addition of both wind and solar. But look what's so interesting. In the early years, there was really 50-50 in additions, right? But look how solar is really beginning to win the day in the renewable energy space. So it's not only that there's competition between renewable energy and fossil fuel energy, there's actually competition as well between forms of renewable energy. And we're seeing that this incredible drop in the cost of solar is really giving it a boost. Solar doesn't have all the moving parts that wind does, right? Wind's got these turbines, and those things, as we know, freeze up in Texas, as we know, happened a couple months ago, and or a month ago, and no, a couple months ago. So solar doesn't have those things, and so those benefits of solar not having as many moving parts is resulting in large plant operators building really large-scale solar. Greenhouse gas emissions. This is what's gone on. We've actually seen in the EU a drop in emission targets. These are targets now for the future. We've seen a rise in China because of the growth of that country's economy, and look what we foresee going now on a path to net zero. Even China, as we head toward 2030, 40, and beyond, this is what the emission targets are. So the world is in a energy transition, the likes of which, you know, we haven't seen anything since humans began to burn oil 150 years ago or so. And this is what we expect the world to look like. Look the fall off in the use of coal as a percent of primary energy consumption. As time goes on, we expect these renewables to ultimately come to occupy half sometime around 2035. That's only about 15 years from now. We expect renewable energy to account for half of the energy consumed, which is a huge, huge change. Electric vehicle sales are starting to really ramp. They still only account for 4 to 5% of total vehicle sales, right? But look how they're ramping up. This is China. The US, fairly small in the area of electric vehicle sales. Large amounts of sales in Europe, and look how the sales are ramping up. And of course, we see that in the stock price of Tesla and the rush by the other motor car companies, Ford and BMW, to come out with cars. I've been looking at the Ford Mustang. It's a Ford Mustang all electric. It's a really good looking car, and I want to go drive it. I'm sort of a Ford guy. So the good news is that the other companies are jumping in too, and so we expect all the car companies to be making really credible electric vehicles. Innovation going on over here on the right in R&D, global semiconductor market growth. So lots and lots of opportunity for innovation that is going on. And of course, that's driving a large portion of your portfolio during this period too. So let's get to stock market performance. This is going back to 1996, and you can see the peaks and the valleys up 106%. The tech bubble crash down 49%. 100% growth in the S&P 500 up to October 9th of 2007, when the market traded at 15.7 times earnings, and then we had the global financial crisis. So it's not that we were so expensive, it's just that we had some real instabilities in our financial system causing that drop of 57%. Stocks were trading at that time at 10 times earnings on March 9th of 2009, which was the low in the market. Barack Obama had been inaugurated as president a month and a half or so before that, And then what began was a long, I believe the longest bull market in history, which ended right here on February the 19th of 2020 of last year, when we were trading at 19 times earnings on the S&P 500. And we had a 34% drop in the market last year. Does anybody even remember that? Does anybody remember the webinars that I was doing back in March of last year? Seems like 10 years ago, doesn't it? It does to me. I look that way too, right now. Look older. But that was only about a year ago. Only about a year ago when we were down 34% and everybody was wondering what was going to happen. Well, what happened is that it went up immediately 78%. So we're 78% through March 31st. Again, these slides are all March 31st, not today. And we've gone from 13 times earnings on the S&P 500 and a level of 2237 on the index to 21.9 times forward earnings, 3973. And I just want to take this moment to say how proud I am of all of our clients. How proud I am that everybody really stood their ground and behaved well, stayed in their seats, whatever metaphor you want to use. Everybody, I want to take this time a year later to say thank you. We're lucky to have clients who will listen to what we say and learn about the markets and about the behavior of the markets. And when these drops, which we see come with some regularity, when they come, we really have an easy job as advisors, unlike a lot of advisors who are trying to keep their clients invested in their portfolios and in their future. We don't have to fight so hard for that. So I want to say thank you to everybody on the call today for that. So if we look up here, where are we? The index is now at 3973, all-time highs, 21 times earnings, which is on the high side. Dividend yield of 1.5%, which is on the low side, and the 10-year Treasury is now at 1.7%. I'll talk about interest rates a little bit later in the call. And look at what performance has been. So since the market low, well, let's look at these. Since the market low, let's look at this one. In March of last year, and I first want to preface this by saying to everybody, you remember how we were getting a big divergence in stock performance last year, and we had some clients who were concerned about it because our portfolios lean a little bit toward value. We have growth in the portfolio, but we lean a little bit toward value because over the long term, value has outperformed dating back to the 1920s. And there are good reasons why value outperforms, that the stocks are less expensive. But last year we had a big divergence early in the year when the pandemic broke out, as those companies that were benefited from the pandemic, especially technology companies and things like Zoom, really their stocks took off, and Amazon stock took off, and there was a big disparity in performance, and that impacted our portfolios last year. And I spent a lot of time at the end of the last year, or toward the end of last year, talking about that ultimately it can't be that valuation has been done away with in the world of investment. It can't be that the law of valuation has gone away or been revoked, because that would be like gravity being revoked in the world of physics. Valuation is most often the most important thing that you face in an investment. And I pointed out that we had a historic disparity between the valuation of growth stocks and value stocks. And so let's look at what's happened since the market low. So here are growth stocks and here are value stocks. And I talked about small stocks and big stocks also last year quite a bit. Well, look what's happened. In the area of large companies, growth beat value since March of 2020, since the low in the market. It beat it by about 4%. But it was a much bigger disparity until recently. Values come a long way back. In medium-sized companies, the return has been 106% versus 96% for growth. So value, since the market low, has now actually outperformed growth. And in small companies, small value companies have performed 127%, the best of all of these different categories. 127% return for small value companies versus 118% for small growth companies. Now, these are nothing to sneeze at, okay? This is certainly impressive performance for every single one of these categories. But we can clearly see that what we expect over the long term, small value companies to outperform large growth companies, that since the low in the market, that's exactly what's happened. All these things have, for the most part, these different value premiums have performed according to expectation. And that's been very good for New Capital's clients in our portfolios, because our portfolios include all of this, but we give a little bit more additional weighting to this area of the market. And so if you are seeing your portfolio outperform, which you should be, this is why. Now, I can't tell you that's what's going to happen for the remainder of the year. I can't tell you that's what's going to happen next year. I can only tell you that historically, that's what we expect to happen over long periods of time. This is year to date, and look at this. Look what's happened year to date. Again, as of March 31st, not as of today, but as of the quarter just ended. Small companies, small value companies, 21% for the year to date. Large growth companies, 0.9%. So all the momentum that was behind the Amazons and the Apples, et cetera, has fallen off this year. 21.2% for small value companies. And of course, now I'm getting inundated by fund companies who are coming to me saying, oh, you need to buy our small value fund, right? Where were they last year in March? Of course, they weren't calling me back then. They're only calling me now after they put up some performance. So look at the value category: 11 for large value, 13 for medium value, 21 for small value. And then look at the growth category: 1%, almost zero, 5% for small. So small companies across the board have been performing strongly. And this is what we would expect as we come out of a recession and as we head into what might be a national economic boom, with the government priming the pump, not just priming the pump, the government literally making available capital for projects all over the place. And it may be that we see the same thing follow in the rest of the world as well. You start to see value companies and smaller companies outperform. So we're well positioned for that to continue. What else do I want to now? What I want to say is, but we are not cheap. The market is not cheap. So here is the valuation, and you can see that small growth companies are trading at 243% of their 20-year average PE, 2.5 times their average 20-year average PE. Very expensive small growth companies. Small, medium-sized companies, medium-sized growth companies, even large growth companies trading 1.5 times. More affordable, and here we are in small value trading much closer to their average. And so that's one of the reasons we've seen money flow into this area, because it's cheaper. Okay. And what we can see here is that the gray bar, so these are different industries, and this is showing before and after November 6th of 2020. So the market started to turn in November 6th of 2020. The gray bar is showing the performance before, from 12/31 of 2019 through the pandemic and through November of last year, through the election. So this is from the sort of the beginning of the pandemic through the election last year. And look, energy got destroyed. So the energy business, look at that, down 55%. Now here is from right after the election to the end of the quarter, end of the month, just end of March. Look at the difference. So this is why I titled the presentation today, "What a difference a year makes." Look at this. It's like Jekyll and Hyde for some of these industries. Airlines industry, down 50% since November, up 65%. Retail, down 50%. And way up now. Hotels and cruises. So you can see that these companies that were taken out and shot have returned. And so this is why I invest the way I do. Did I go and sell these companies out of your portfolio when they fell in price? No. Had I done that, had I gone and sold all the airlines out of your portfolio, look what you would have missed. So we don't invest that way. Look at this, online retail. So here's online retail, took off during the pandemic up to the election. Look at that, 65%, okay? So if I had taken all your money and chased after all the online retail, how would we have done from November of last year until now? Here, this is what you would have done. See that little stub right there? That's how that industry has done. That would have been your return, and you would have missed out on all of this. Okay, so I really like this slide. Very educational and really should help everybody understand why we don't just chase the market in either selling something that's performed poorly or buying something that's gone crazy, because very often what happens afterwards is completely different. Where do we stand on valuation now? Well, here it is. We mentioned it, 21.88 as of March 31st. And you see that as a high valuation that was last seen back during here, during the tech boom and then subsequent bust. So there it is. What can you expect when markets are trading at 22 times earnings going forward, right? That's the real question. And the answer is not much, right? Here is the return. These are all the years of past returns going back. I don't know how many dots that is. Let's say that's 50 dots, 100 dots. So that's 100 years of returns on the S&P 500. All right, and you can see the dispersion. This is total return. This is subsequent one-year returns. And so when the market's trading at 21.9 times earnings, which is right here on the x-axis, okay, subsequent one-year returns might be about, I don't know, 3% or so. What about subsequent five-year returns? Subsequent five-year returns, we see a much clearer pattern. And what the charts are basically saying is that the higher the valuation goes, along the x-axis, and we're here right now on the x-axis, then the less you can expect in future returns. And this is the historical data to show you that. So I'm glad everyone's enjoying their portfolio as it's performed since the market low last year. But this is what we have to expect, which is pretty muted returns. I'm sorry to give you the news. This is pretty interesting. Everybody was chasing the top 10 stocks recently, you know, whatever, Apple and Google and so on. Current PE on the top 10, 30 times earnings. 30 times earnings. And the last time we had the top 10 stocks approaching the level of valuation in terms of their multiple of earnings was back in the tech bust. And look what happened to the top 10. This was the era when it was WorldCom and Enron and Dell Computer and Cisco Systems. Remember all those companies? This is what happened next. Now, I'm not saying that's what's going to happen now. Very different period, very different companies, a lot stronger these companies now, but this is what the history shows. And then here's the remaining stocks. So look, the remaining stocks are still trading at fairly reasonable valuation. So this is why we own the entire market. Look at the valuation dispersion, right? Look how tightly between the most highly valued and least valued stocks there were in 2009, between the highest PEs and the lowest PEs in 2009 during the crisis. Look at that. All the values compressed in 2009, right? Everything was cheap. Look at that. The highest thing was 15 times earnings, lowest thing was down, 7 times earnings, right? For an average of 10 times earnings. And look where we are now. Look, the most expensive stocks and the least expensive stocks. Look at the spread between those. It's really the highest spread we've seen going back to 1996, and it may be the highest spread ever. Look at 1996. Look at, again, very tight spread between the most expensive stocks and the least expensive stocks. And then it went crazy during the internet bubble, and here we are again. Here is the earnings to coupon yield on a 60-40 portfolio. And what this is showing is that if you take what the bond yield on the bonds are and the yield on the stocks, and you put them together in proportion to their presence in a 60-40 portfolio, stocks being 60%, bonds being 40%, that this is the forward earnings to price ratio plus the bond yield. And the long-term average has been 6.22. Going back to 1985, we saw as high a yield as 11%. So in other words, 11% back in 1985, had you bought a 60-40 portfolio split between the S&P 500 and the Barclays aggregate index, you would have expected an 11% return on the portfolio, and probably that's what you got over the next decade. But look where we are now, 3.21%. In other words, a standard 60-40 portfolio with the S&P 500 and the Barclays aggregate, right now we would expect a average annual return on a 60-40 portfolio to be 3.21%. So this is a major conundrum in the investing world. So how do we think about solving it? Well, one thing we do is we break out of the S&P 500, which is an expensive index. And as everybody knows, I've been investing you internationally, and international stocks have really done well over the last year. I think in many cases may have beaten US performance last year. So we will continue to invest internationally, and international is more attractively valued than the S&P 500. Again, we're trying to solve for this problem here in your portfolios. Many of you own a 60-40 portfolio. So by not giving you only the S&P 500 and giving you some international exposure, look what you get. Well, the international stocks are trading at a 25% discount to the United States. So by adding less expensive assets, international assets, hopefully we can see a higher return than what we would otherwise be looking at if we just held the S&P 500, right? We also get a higher dividend in international stocks. So the dividend is higher than average. The average international dividend is about 1.1%, and now it's about 1.2%. I think we actually are paying out a higher international dividend because we tilt toward value stocks, which tend to have higher dividends. So this is one of the main reasons that I've been diversifying you internationally, is that we're getting a less expensive security, and we're getting one with a higher dividend, and hopefully we don't face this 3.21%. Maybe international stocks can bring us another % of performance and take it up into the 4s. And then emerging stocks might take us up, emerging market stocks might take us up to about 5 or so. So those are the things that we're going to need to do, is to diversify internationally to be able to put up returns. And then I think this is the last slide, and then we'll take questions. we can see from this slide that interest rates have moved. You may remember that we hit a low on August 4th of 2020 of last year. And on August 4th of 2020, the 10-year Treasury bond was at 0.52%, 0.5%. And it was at that point that I began to make really strong concerted moves in your bond portfolio to reduce duration. I didn't want you to hold longer term bonds in as high a quantity as we were before. And so I've been reducing the exposure to these longer term bonds into these shorter term bonds here. And that's been a good move, because as you can see, the 10-year Treasury bond has gone from 0.5% on August 4th of last year to 1.74% on March 31st, a couple of weeks ago. Well, what impact does that have? Well, that has a very negative impact on the price of the 10-year bond. So if you held the 10-year bond on August the 4th of last year, and you held it for about a year, and we lost about 1%, or rather the interest rate rose about 1%, which is what it did here, about 1.2%, then we would have lost about 10% in the value of the bond. That's called duration. And so when interest rates hit this low, we began to move clients, not entirely, not completely, but maybe half your bond portfolio, we began to move towards short-term instruments, and that's been a very good move. Our bond moves have also been very good. So it's been a very good time for both our investments for you in stocks and also in bonds. And then here's December 31st of 2013. Look where bond prices were during, you might call it a normal time, right? That would have been 4 years on from the financial crisis, and things were normal, I guess you could say. And look where interest rates were. The 10-year Treasury was at 3%. So it may be that, we've got a ways to go here as this curve of interest rates reflates. We may see it continue to move up. And so we're continuing to keep bond investments on the shorter term side, because that's what I'm worried about, is that with the backdrop of fiscal spending and the low rates we've had, that we may not be finished with seeing increases in interest rates. And that will impact all investments, including stocks and including bonds. So right now, I don't see a huge amount of changes to our portfolios. We did increase the amount of real estate that we held. So we have been doing a little bit of acquiring of some additional international real estate, because real estate got really cheap last year. So we've liked that pretty well, but we've only added a little bit to the holding. We don't want it to get too big. So I think that is it on the slides. Yes. So let me bring Catherine back, and welcome back. And if there are any questions, I'll be happy to take them. They can be about anything, really. I'll take questions on anything, whether it's anything I talked about today or just anything else on your mind. We haven't had a call in a bit, so I just said we'll take all comers today in the Q&A.
And there's one comment that came in so far, so I'll read that out in just a moment. Also, before anyone drops off, I'm going to put a link in the chat functionality, which is a link to our webinar evaluation form. That should just have come through. You should be able to see that. So if you could, before you jump off the call today, if you could click that link and submit the evaluation, that would be wonderful. One comment that came in during the presentation, and actually, Leonard, if you like, I can share this with everyone as well. It's a link to a New York Times article. It says, not just a question, just wanted to share this piece from the Sunday New York Times entitled, Looking Back at the First Roaring 20s. Very interesting. On some ways, investors found themselves ambushed by the unexpected. So that's an article. I can see if we want to share that.
Yeah, let's do that. Let's do that. Thank you, John, for that. It is important that we as investors understand that what happens in the real economy, it is not necessarily what has to happen in financial markets and in financial instruments. We have seen a rapid reflation in stocks. Everybody here on this call has felt that, and that's felt good. I'm a stockholder too, and I like seeing my portfolio go up. But stocks look ahead, and the stock market, I think, has been looking ahead for a long time at what is now about to transpire in this country, which is a very, very large infrastructure build. There are so many things to fix. The prevailing attitude of the politicians in power over the last 40 years of my life, even if it hasn't happened in practice, the attitude has basically been one of austerity. It's basically been one that the Treasury cannot be put at the disposal of the American people if it's going to cause deficits and so on. So the country has been capital constrained in undertaking rebuilding projects and maintenance projects. But it looks like that's going to come to an end. That doesn't mean that your stocks are going to go up just because things start getting fixed and built and so on. Stocks could go down. They are not the same thing. And so I want to caution everybody about that. Don't just think that because we get a roaring 20s part 2, if that's what we get, where everybody's drinking and jazzing and dancing and, coming out of the pandemic. I mean, it's eerie how similar in a way things feel. But history rhymes, it doesn't repeat. And so I don't know, stocks were valued at the beginning of the 1920s in a particular place, and they ended the 1920s in a different place. We're beginning the 2020s at pretty high valuations. And so investors, I haven't read the article, but I'm assuming this is sort of what it says. Investors should not assume that a roaring 20s now is going to, that the benefits of that are going to accrue to investors. It may be that investors have already gotten theirs, and now it's going to be time for labor to get its. So thank you for that. Any other questions?
Sure. There's one that came in. It says security will be the #1 concern in the next 10 years. How is Orion positioned against, and they said North Korean and Russian hacking? And then there was another side comment that said, keep an eye on India regarding COVID. The wave is now forming with new mutations.
Okay. All of the top portfolio reporting systems are extremely strong in security. And Orion is as well. We're probably going to force everybody to go to double authentication with the move to Orion. And the systems are getting better at that, because I like it when they use your phone. I don't like the thing where you got to get the random number generator. I like it when they send you a code, on your phone. That works best for me because my phone's with me all the time, and I'm sure yours is too. But Orion has extremely strong security. They are a big player in this field. They work with some very large organizations that have tens of billions of dollars under management. Our contingent successor, Buckingham, is on Orion, for example, and several companies in my study group that I go to in Austin are on Orion. So I've done about 2 years, if not more, of due diligence on Orion, and it's a very strong company. We're excited about it. And we will probably do double code authentication for clients on Orion. So thanks for that question. We'll have a lot more on Orion for sure, and Orion security. Okay.
Sorry. There is another question that came, how to participate in the need for climate change. Where are opportunities in climate change?
You know, we're hitting breakout in dealing with climate change, and the answer is, it's such a big thing. It's really going to be everywhere. Um, um, every company is going to be impacted by it. If you're in transportation or you're in retailing or you know, whatever you're in, there are going to be efficiency gains that are going to have to be made. Whether you're a financial advisor, it's not just going to be, you know, solar panel makers, right? It isn't just going to be, it's even going to be energy companies. Okay, those energy companies, those fossil fuel companies that figure out how to do climate change focused change within their companies and yet still do fossil fuels, because we're going to need fossil fuels. Okay, if every Texan didn't get that message back on, what was the big freeze date, Catherine?
February 15th, I remember specifically.
If on February 15th you didn't understand that we're going to need some fossil fuels, you know, that when the sun is not shining and the snow's falling, you know, that we need base load electricity, you know, then you don't get it. And it's the same thing. The building I'm sitting in right now is off the grid. It has solar panels right above my head on the roof. It's got a wind turbine right out there, but it also has a backup generator. And so, you know, I need fossil fuels. And so my answer is that it is such that the challenges that face everybody now are so big that all businesses are going to be impacted by it, and all people. And so every time I try to say, okay, you know, let's look at a mutual fund that does just this little sector, nothing good ever ends up happening. You know, I mean, it tends to lose a lot of money, and it's uncorrelated. And so we have put a lot of our clients into the sustainable funds. And I like that approach. I think that's the right way to go, because you're getting a mix of all industries. And you saw from the slide I showed, I mean, I can go back to it. I mean, let me go back to that slide. You know, this one right here, is it showing? Am I showing the slide? Yeah, I am, right? You know, this is why we need a balanced portfolio, because one year something's terrible, the next year it's the top performer. One year the thing is the top performer, the next year it does nothing. I can't tell you when that's going to happen. That's not what I'm here to do. I'm here to give you returns that are available, attainable, and to some extent predictable. Okay, next question. Ready for it?
Yeah, sure. It says, any comment on the cryptocurrency market, particularly environmental cost of mining?
You know, I'm frustrated, and I'm glad somebody asked about crypto. I'm frustrated about Bitcoin, because obviously I've seen the steep rise in the price of Bitcoin, and I could see clients holding some Bitcoin in the portfolios. The problem is it's very hard to get to, and a number of ways presented themselves. Late last year, as I mentioned, Fidelity came out with a Bitcoin fund. The problem was that it has a $100,000 minimum. It's a private equity investment that requires signing, you know, 100 pages worth of legal documents. The liquidity isn't exactly what I would want. It's got a 1% management fee. And that was about the best way that I could see getting access to Bitcoin. There are all sorts of actually, funds that are trading, but they trade at either extreme premiums or extreme discounts, but usually extreme premiums. Coinbase just went public, and they charge, I don't know, 3% just to buy the thing. It's really a crazy thing where you've got more people wanting this thing, and nobody's sure what the real value of it is. So my response is, I have been studying it very, very hard. If I could find a way to get clients to it in a way that made sense to me, then I would, and that will probably be coming along. There's a lot of look at an ETF, which would be an improvement, but it's not out yet. The SEC has not approved a Bitcoin ETF. So the bottom line here is that everybody sits and watches the thing go up, but it's not easy to get to. It's just not. and a couple of clients I tried to help last year, and it ended up kind of burning me. And so we have to be careful there. All right, anything else?
Yes, another question. Do you know anything about Engine One challenging ExxonMobil board?
No.
Okay.
No, I don't. But you know, ExxonMobil and other oil companies, you know, they'll have to figure out what they're going to be doing in the future. There's nothing that says they can't enter the solar market, or they can't enter, you know, that they can't go from being fossil fuel companies to true broad-based energy companies. And there are among those companies that are doing that. I think Shell is doing it to a much greater degree. And so that's why I say, you can't just say that addressing climate change is only going to involve solar panel makers or wind turbine. No, it's going to involve everybody. And the change is going to be made at the margins. So there's room for oil companies that can figure out how to play in the climate change era. But I can assure you that your portfolios include those companies that are going to be making change. We're positioned to capture returns as companies fix this problem. Anything else?
That is all the questions that came in. I think we are good.
Okay, everybody, thank you very much. I will look forward to being with you probably next quarter. If you have anything at all that you need between now and then, whether that is from me or any of our extraordinary staff, which continues to be extraordinary 1 year after this pandemic began, we're just doing incredible things. I couldn't be more proud of everybody. Please do not hesitate to ask. We will help you as fast as we can and as well as we can. So thank you very much for your trust and confidence. It's been great to spend some time with you this afternoon. I'm really glad I got to do it and sort of talk through the issues that we're seeing. I didn't talk about inflation. If anybody had a question about that, we continue to hold large amounts of inflation protected bonds. So if we see a big boom in inflation, you will be well positioned for that also. Thank you.